Hi, and welcome. Welcome to the Red Wagon Estate Planning and Elder Law Show, hosted by me, yours truly, Jeff Bellomo. We hope you're doing well out there today. We just wanted to remind everyone, not only this show, but also any other show, please do not take legal advice and make decisions based solely upon the information that you hear on a radio show. It is for informational and educational purposes only, and it does not constitute an attorney-client relationship. And if you are looking for legal advice, please reach out to an attorney in your state that practices in the area that you are looking for, and they will be able to assist you. If you happen to be in Pennsylvania, give us a call at Bellomo Associates at 717-845-5390. We would love to assist. All right, now let's get to the show today. Today's going to be a fun one. At least I think so. So hopefully you will as well. We get questions all the time, or maybe I should rephrase that and say very often we are kind of commented in a workshop or even one-on-one in an office meeting from a client who says, you know, when you mention the word Medicaid, right, they immediately have a reaction, right? Good, bad, indifferent. The person on the other side is immediately forming opinions when they hear the word Medicaid. So over my 20-year career, what I am noticing and what I kind of hear all the time is Medicaid means the county home. They're going to take all of your assets. They're going to take your house. If you give anything away, you have to wait 60 months to be able to qualify for Medicaid. And if a person is already placed in a home, it's too late. You have to lose everything. You have to spend down to the $2,400 and effectively, be spent down completely. All right. So all of those are false. Every one of those that I just said are myths. They're not true. It is not the case for the situation whatsoever. So let's take a step back and talk a little bit about Medicaid. All right. It's a federal program. The laws or the main rules that kind of govern it are OBRA 96 and DRA 05, okay? Those are the two kind of major pronouncements of authority of law that tell us what do we have to play with, or what are the rules for Medicaid, okay? Now, the reason that I was able to travel the country for 5.5 years and teach lawyers across the country about Medicaid is because it's a federal program. It's a federal law. So it allowed me, someone from Pennsylvania, to go and teach it nationally. Now, every state has the right to interpret the laws and the rules the way that they see fit, right? So the federal government puts out kind of the guideline, and then the state gets to interpret that guideline, and then they get to kind of finally set the rules that they're going to play by. And so in Pennsylvania, we have something called a long-term care handbook. The long-term care handbook is essentially Department of Human Services pronouncement, if you will, of what the rules, the regulations, what should a caseworker who is working in a county in the state of Pennsylvania, looking at an application, what should they do? What are the rules? What governs them, right? So those are the things that the handbook is going to tell them and answer. Now, the good news is we also have access to the handbook, okay? They do make it public. They do make it so that you have the ability to read it, to check it out, to know the rules. So that is huge, right? Because going in what counsel for DHS is telling their caseworkers to do and telling them how to interpret a certain rule that is set in the federal law. Now, that doesn't mean that they're right. It doesn't mean that an attorney or someone isn't going to fight them and to try to change it, but that isn't where we are. That certainly isn't where we at Bellomo Associates are. I don't have enough time in the day to fight a federal litigation or to do any type of litigation whatsoever for that matter. We're here to help families. We're here to help protect assets. So I would certainly defer that to someone else, someone else who has the ability to do that. That is not me. But that's out there. Certainly we understand that. And as any laws can change. Interpretations of laws can change. So case law can change it. DHS counsel, a new attorney for the state comes in, it's possible that they're going to change slightly some of the handbook or, the interpretation. So we always have to be mindful of that. But as a general rule, we're pretty certain, we know the rules, we know what to play by, and we know what it is that we have to do. So as far as the one myth that I want to kind of talk about first is Medicaid equals the county home. Well, first of all, that isn't true. If you take a county like York, for example, there's approximately 17 nursing homes in York, and all but one accept Medicaid. The only one that doesn't is Dallastown Nursing and Rehab on Main Street in Dallastown. And that's the only one that I am aware of that does not accept Medicaid, meaning every other home does. And I know that there were rumors in the last year or two that even Dallastown was looking into it and trying to figure out what that would look like, because you almost can't make it without it. Medicaid is almost a requirement because it's so expensive to run these homes, and most people can't afford it. So they need assistance. They need the ability to have a government program paying to them consistently, on time, every month. But either way, there are certainly at least 16 other options that you could go with. And also, just a reminder, for those of us in York County, only a couple years ago, before the county sold Pleasant Acres, the county home was rated probably the highest in all of York County. And people were fighting to get into the county home. The county did a great job of running it. They were bringing in great doctors and nurses, and the care was phenomenal. So I just want to throw out that and debunk that myth is, no, it can be any home, right, that accepts Medicaid, which they all do, and except for one. And to the extent that there is a county home, that doesn't mean that it's bad. That doesn't mean that it's poverty, horribly stricken, and that it's this terrible place. We had probably the best one in the county at one point. Now, I will admit, since they sold it, I hear it has gone downhill a little bit. It isn't the same place that it used to be. Okay, totally get it, totally understand. No argument there. But that doesn't mean that all county homes are bad. Okay? The second myth is they're going to take your house. The state of Pennsylvania has no interest in your home. They have no interest in owning your home. Where that myth comes from is something called estate recovery, okay? If you own an asset in your name at the time of your death and you received Medicaid benefits, the state of Pennsylvania has a right to get paid back up to the amount of care that was provided, right? So if you were receiving benefits during your lifetime and you own the home in your name, right? There's something fancy called with the intent to return home. If you intended to return home, which obviously in some people's minds everybody does, you can exempt the house and still receive Medicaid benefits. But when you die, right, the state of Pennsylvania says, okay, now we have a right to get paid back up to the amount of care that was provided. So I have a lot of thoughts there. First of all, they didn't take your home, right? They didn't come in, they didn't take it from you, they didn't take the deed from you, they would never do that. It's simply a lien that gets collected, okay? So that's the first part of that. But the second part of that is that in 99% of cases, we're not going to get somebody qualified and simply leave the house in their name, okay? That's not a technique that somebody who knows what they're doing is probably going to do. Now, I'm leaving an opening there because there have been times where we had no choice for reasons outside of this podcast. But for a regular rule, a majority rule, the truth is we're probably not going to leave that house in the individual's name, okay? So with that said, and if we do, it's going to be jointly owned, and estate recovery only goes after the probate estate, meaning assets that are in the person's name alone. Okay, so if they own it jointly, it's not in their name alone. The state cannot go after it. That's usually one technique we use, or we make sure it's not in their name at all, and we go ahead and do the rest of the plan, and then we're able to not have it in their name. So again, they can't go after it, okay? All right. that's the home thing. Now, as far as taking all of your assets, if you look at the law on its face, it does appear that you need to spend down to $2,400 or $8,000 of assets if you're going to qualify for Medicaid. And in PA, that depends on your income. So if your income is greater than $2,523 a month, you can have less than $2,400. If it's less than $2,523 a month, you can have less than $8,000. Okay, now neither one is a huge number. I agree, admit, yeah, guilty. However, that is just what we know we need to get spent below, right, in order to qualify somebody. And I'm going to throw in one more comment about estate recovery. Estate recovery is going to go after any assets in the probate estate of the individual greater than $2,400. So there are times, almost always, where we're going to keep people less than $2,400, even if they're allowed to get up to $8,000. Now that causes a lot of confusion, right? Because there's a lot of people who think they know everything about everything, and they tell the client, "Oh, you could have had $8,000. Why did he spend you down to $2,000?" It's because I don't want the state, when you die, to go after it through estate recovery, force you to raise an estate, force you to pay a lawyer only to pay the state the remainder of the money. The only people that win in that instance are me, the lawyer. So there are reasons why we do certain things. And as a general rule, we're going to keep you down around $2,000, right around $2,000. That way we know you're going to be qualified either way. And we also know that there's going to be no estate recovery when you die, assuming there's no other assets in your name alone, which there couldn't be, or you would not be below the threshold. Okay? So those are some of our general comments there about just the house, the Medicaid, the county, and those kind of things to start out with us, all right? All right, now, the next myth that we want to talk a little bit about is if you give assets away, you have to wait 60 months, okay? So first of all, I do want to kind of debunk that myth right out of the gate here. That is not true, okay? In fact, we do a ton of planning, what we call crisis. So crisis planning is planning that you're going to do when the person's already in the home or just before they kind of go into the home, you're going to put the plan in place. It's called crisis planning, okay? So that by itself tells you that we are planning to do something last minute. So if we do we really have to wait 5 years? No. There's something called a look back period. And a look back period is essentially a 5-year period, 60 months. The way I explain it is put a box on the table, right? What goes in the box? Statements from the past 5 years. So everything that you own for the past 5 years, every account statement goes in that box. Okay. So now the caseworker is going to go through every line of that box to figure out what have you given away, right? What were the gifts? Gifts are transfers for less than fair market value, okay? So that's important to remember, right? Because when you go and give money to the church, or you give money to the grandkids, or you give money to your neighbors, right? Those are gifts. Now, what trips us up is that under the tax law, we're allowed to give away what is called an annual exclusion gift of $16,000 a year. So people get confused and they say, well, I'm allowed to give $16,000 away. That's for tax purposes, not necessarily for long-term care purposes. So those of you who have been to our workshop, those of you who have listened to this podcast, you know that we have something called the 3 lands to your family security. We talk about tax land, long-term care land, and estate planning land, right? And that's the whole point of that story is you can't be giving stuff away in tax land just because you're allowed under the tax rules without having an implication if you end up in a long-term care situation. All right, so that's the kind of a starting block. Now, let's say we did give $10,000 away, or maybe more importantly, let's give about $14,000 away, okay? So we give $14,000 away, and that's going to be a 1-month penalty, okay? Notice I didn't say 5 years or 60 months. Currently in Pennsylvania, the penalty divisor is $14,676.04 a month, or $482.50 daily. Okay, so you take the total amount gifted, $15,000, turn it into that $14,676.04. So it's going to be 1 month, in a couple days of a penalty, right? If you do it by the daily divisor, that tells you how many days. If you do it by the monthly, that tells you how many months. Obviously, depending on how big the number is, depends on which one you're going to use, okay? But it doesn't, at the end of the day, that just tells you how long the person is going to be penalized. In a married case, there won't be, right? In a married case, we're able to protect 100% of the assets for the spouse with no penalty. Why? Because the government allows us to make transfers unlimited to the spouse, and the government also allows us to purchase something called a Medicaid qualified annuity. Okay, so both of them are allowed under the laws that I mentioned earlier, DRA 05 and OBRA 96. It's essentially turning an asset into an income stream and allowing us to stay qualified because it's going to the community spouse. Perfect. In that instance, we're not going to have a penalty. We're going to get approval immediately, assuming there's no other gifts. In a single case, widow or widowed, little different, okay? Now here, you got an individual in the nursing home. They gift $50,000 to their son. Now that's not good, right? You're gonna get your hand slapped for that because you gifted $50,000 away during the 5-year look-back period. Okay, so what's the penalty going to be? Well, let's take that $50,000, take it by our divisor, the $14,676.04. That tells us how many months we're going to be penalized. Okay, we'll take the other half of the money, right? We gifted 50, we still have 50, and we say, okay, no problem. I'm going to take this 50, purchase what is called a Medicaid qualified annuity. It's going to be a very short, probably 2-3 months at tops. And then that is going to pay the nursing home their full private pay rate for the penalty period. Plus, the individuals who receive the gift are going to have to put a small amount in. It's called, we're short. We're short a little bit every month, which you want to be, because if you're not, you can't qualify. That shortage has to come from someone. It comes from the person who received the gift. So now the son says, no problem. I got $50,000 here. I'll take part of that $50,000 and I'll pay the couple $100 or the $1,000 or whatever it is for the 2-month period. At the end of the 2-3 month penalty period, voila, we are qualified. Okay? Now, if the person died during that period, there is no benefits being paid by the state yet, right? Because during that penalty period, we're still private pay. So because of that, if there's any money left in the annuity, it can go to the beneficiaries because the state has not been paying out benefits. So that's the good news in that instance, okay? But the bottom line is there isn't a 5-year penalty period. It's a 5-year look-back period. The penalty period is based upon that divisor, whether it be the monthly divisor of $14,676.04 or the daily divisor of $482.50, okay? So that's the penalty part. It's based upon how much you're giving away. And that's the one thing I want to kind of warn everybody is dealing in cash is very risky, okay? Cash is tough because we can't prove what happened. So if you go to your bank, your ATM, and you pull out $1,000, and then there's no record of what happened to that $1,000. Did it go to utilities? Did it go to groceries? Did it go... Now, all of a sudden, when we end up filing a Medicaid application, we're behind the 8 ball, right? Why are we behind the 8 ball? Well, because I can't prove what happened to the $1,000. I know you took it out, right? They're going to look at every line of every bank statement, but I can't tell the county conclusively what happened to it. Their assumption is that I gifted it to my son. Now, I didn't, but I have to prove I didn't, and it can be extremely difficult to prove you didn't. So typically what we tell people in workshops is stop dealing in cash, right? If you're a person that doesn't like credit cards, please use a debit card. It comes right out of your checking. Very easy to see what was used, how much was spent, where was it. The fact that I could prove it wasn't gifted because it went right to Lowe's or it went right to the grocery store. So that's much easier to be able to kind of manage when I can just prove exactly what happened to the money. I know for some of you that's very difficult and you're struggling, and I've gotten into some pretty heated discussions with some of our clients over it because they want to deal in cash and they're used to it, but it really makes it difficult for your family later. And in some cases, you end up not qualifying in instances where you should have, simply because we cannot prove exactly what happened. So, it's always fun in the Medicaid arena. Every case is different. Every case brings up or poses new challenges. And certainly it's always kind of fun and intriguing to see, what's the case going to bring up? What are we going to have to do to pivot? But what I wanted to talk about today on the Red Wagon Estate Planning and Elder Law Show was just simply the myths, right? They don't want your home. They're not going to take your home. If you give assets away, you don't have to wait 60 months. The Medicaid doesn't mean only the county home, doesn't mean it's bad, doesn't mean that it's going to be the most horrific place in the world. And yes, you can still protect assets if a loved one enters a nursing home. It's never too late. The only time it's too late is when there's absolutely no money left. Prior to that, there's always something we can do. There's always some way we can lessen the gifts and hopefully get somebody qualified. So I hope you enjoyed the show today. I hope we were able to debunk some of the common myths that we have with Medicaid and with estate planning. And I'll leave you with this. A lot of people kind of ask, Jeff, is this planning, right, good? Absolutely. It's the law, right? We're allowed, it's set in law. Years and years ago, before I knew a lot about this area, I would tell people we couldn't do it, right? And one of my friends made it very clear to me, Jeff, that's malpractice, right? You know that something can be done. Maybe you don't completely understand it yet. Maybe you don't completely believe in it yet, but you know it can be. So the truth is, yes, the answer is yes. And I realized pretty quickly that is true, right? It is the law. It's absolutely allowed. And, to me, this is the, only area whatsoever where they're really allowing the middle class to have sort of a tax break or a tax advantage. The wealthy get all kinds of loopholes, all kinds of advantages in regards to tax planning. The middle class does not. So this is that one area left where middle class people, a couple 100,000 to maybe $1.5 million, $2 million, don't have to lose everything in a very short period that they spent their whole life saving. And the law allows it. The government sets the rules. So we're just simply abiding by them and enforcing them. So I want to thank you very much for joining us on the estate planning show today on the Red Wagon Estate Planning and Elder Law Show. I'm Jeff Bellomo. I'm your host. I look forward to seeing you on the next podcast, the next show, and learning a little more about estate planning and elder law, or who knows, maybe we'll have a great guest on the show and we'll talk a little more to a guest about something and kind of have a little bit of fun. So thank you very much for joining us, and we'll see you real soon.